This is Tom Aspray with a Viper Report Market Wrap video for the week ending April 2nd. The theme today is watching for the new leading sectors. We're happy that last week was only 4 trading days and we get Good Friday off because it was pretty crazy, as it has been for the past 3 weeks, but this week's action was pretty significant. It puts us in a position where we want to start looking for those sectors that are going to lead in the next market rally, as a bottom was likely formed last week. You can see this chart shows you a comparison of the S&P 500 in red, the QQQs here in dark blue, the Russell, in green, and then the Russell 1000 value, which you can see, held up the best during the decline and has also rebounded nicely. The rest of these has rebounded pretty nicely. You can see that the Russell got dumped last week, and it's gone from down 11 to back up to 7%. So that's a pretty interesting development, as are some of the technical studies that we'll get to shortly. Another chart for you to look at is on the sectors. Looking at, energy, of course, has been a stellar mover. Still, it's had a pretty good setback last week. I don't think the top is in yet. If I look at it in terms of the outcome for the hostilities, I hope it has, but I'm not sure that's realistic. More interesting down below, you can see some, improvement here. The light blue, that's the materials, which our friend Jerry A. says is the newest emerging sector to keep an eye on. Real estate also is keeping pace there. And then down here we have financials, which we're already in and has some positive signs for me, as well as technology has had a nice rebound, but has not flashed the kind of buy signals I'm looking for yet. In terms of the overall market, we started to see some encouraging signs last week. This is the New York Composite here, the broadly based one, who had finally started catching up as we got into February and early March, but then started its correction. You can see this wide-ranging bar below its 20-period moving average, which has been declining steadily. That's a sign it was too early to buy, but now it's starting to flat out. More importantly, below it we have the McClellan oscillator. Students of the advanced decline course will show that it's not always a great indicator to watch, because usually the advanced decline line itself shares more valuable information, but occasionally at market bottoms in particular, it sets up this kind of formation. So NYSE made a new low here. As I noted at the time, we got down in the minus 220 area. That's about a little above where we got in April of 25. Then we made another new correction day 5 days later. McClellan oscillator was higher. Okay, so that was your first bullish divergence. And then, last week's the early drop here in the start of the week, you can see it made another higher low. So multiple bullish divergences and back above zero. That's a good sign. And dovetails with the AD line analysis. Any pullback we see this week should hold just below the zero line. We've been noticing that we got close to the stark minus bands on a weekly basis for several weeks. You can see, closed below it here, there, and this week, the low was at 629.28, and the stark band was at 631.41. So once again, we traded below it, right into the support, and lo and behold, the weekly S&P 500 AD line flipped back to positive, back above its moving average. In addition, from dropping back to the lower weekly stark bands, you can see here we have a plot of the bullish reading from the AAII survey. You can see that just the bullish number went from close to 50 here down to 30. So that correction has zapped all this bullishness. We don't have current numbers yet for the cash levels from the B of A survey, but I'm sure they went up, particularly in the last week or two. How high is the question? And if you look back, Lois, this is the NAAIM we talked about last week. You can see that they used to have 100% allocation. Now it's at 68. It was got a little lower a couple weeks ago. So that creates that buying pressure on the sidelines, which is all important. That decline from new highs and pivot resistance at the start of the year also resulted in the AD lines. This is the S&P, dropped all the way back to its 21 period exponential moving average. This is the stocks only. It also came into support here and has turned positive, as did the NYSE all. So that's pretty strong evidence that the correction is over. Given everything that's going around in the world and the bond markets, etc., we could still see another setback, but I would think, like the setback on Monday, most of the markets that I like held up quite well and all finished off the worst levels. So if you look at the QQQs, we got right down close to the yearly pivot. The low was at 555.60 and the pivot is at 549.40 down here. So you can see that it moving average just flipped back above its moving average as well, and RS is still slightly negative. In other words, it's not back up. It's not indicating yet that the Qs are leading the S&P, but that is getting closer. So we'll be looking for a strong move above these peaks to indicate the Qs are once again a market leader. MACDs on the Qs are still showing there's a negative momentum split. One of the indicators we've been watching carefully throughout the correction is the high-low, and so we got a spurt back up here above 500 and above this peak, but so far we haven't seen any follow through. That's the only indicator I'm finding that sort of could still turn negative. So we'll be watching that on a daily basis. Obviously the number of new highs is quite low, which you would expect. If you look at the NYSE, it shows a similar pattern. We got slightly above 200, last week or so, and but still, not what we're used to seeing, particularly in NASDAQ, where you would expect to see the selling as being heavier, and so far it hasn't. You can see that, the NYSE composite has hit this good uptrend support, so that's a plus. With the weekly studies quite positive for the Qs, the daily have not really yet caught up with it. So we just rallied back above. We closed at 584.98, just above the new monthly pivot at 581.77. So we could still get some back and filling in here. AD line has had a nice rebound after breaking its support, but still it needs to go further, and it needs to have the moving average turning higher. Same for the relative performance on a daily basis. Appears to be bottoming, but a strong move through this downtrend and the moving average rising, that would be better evidence. I wanted to bring this chart up again just to kind of give you a little different reason why I was pretty confident this wasn't a bear market. So in a bear market, you transition from more advancing than declining stocks to more declining than advancing. So, we have this high in late February. AD line took a pretty good hit down to right around in here, but look at the price level then was below 6,400 in the S&P cash, but look at and it was below this low, so the prices had broken support, but not the AD line. AD line was still acting much stronger, a sign that even though prices were lower, fewer stocks were pushing it down, and that's what we see. That's what I saw in 2018, and was turned out to be a great signal. I still get periodic notes from people who didn't sell out their longs in 2018 and how happy they are. There's also been some interesting improvement in the number of stocks above the various moving averages. Here we have a combination. In green we have the percentage of NASDAQ 100 stocks above their 200 days. So it made it down to 40 here. It's trying to form a little bottom. Like to see it move back above 50, to turn it more encouraging. Below that in red, we have the stocks above their S&P stocks above their 50-day. You can see it didn't get nearly as oversold as it was in April of last year, but it's also trying to turn higher. It's starting a new uptrend, because it went from a pattern of lower lows and lower highs to now we have a higher high. So any pullback, we'd expect to hold around the 25 area. And then above the 200, it's still below 50, 49, but may be sold out, may not. And here you can see we have another confirmation by some of the AD lines that the market was not as bad as it looked. The VIX and the VXN reversed sharply last week, so that's kind of what you'd want to see. It dropped near the daily Stark bands here, but then cracked, and they appear to have, broken their short-term uptrends here. We'll draw these in. That's a good sign. We'd like to see really a drop below, say, 25, 23 here on the VXN, and back below 20 probably in the VIX to suggest, okay, it's in a new downtrend. That's bullish for stocks. This is a chart I showed many times last year. Basically, it's crude oil up at the top here, and the fact that the RS of the crude oil versus the S&P, that crude was continuing to be weaker and kept us out of jumping in the long side a while. And this chart suggests that it's extended right in here, but not necessarily that crude oil has made a top. And of course, those of you familiar with my work, I also look at the futures. So if you look at, here's a weekly chart of the crude oil futures. OBV very strong. The Herrick Payoff Index uses volume and open interest along with price action. It staged a pretty good breakout here and then surged heavily. We're up near the upper weekly Stark band, so currently extended, but it does appear to have some pretty good support here around the 96 area. And we can look at a monthly chart. Gold is a little tougher call. Chart of the gold futures, plunged pretty much last week. Got down to the minus Stark band here. OBV, has made a new high. No divergences. HPI took quite a hit. Likely you have to look at the open interest pattern. Suggested that. So we took some nice profits on that since really for 25 on. You can see everything's been pretty strong. So we're on the sidelines there. Some of you may have read my past articles on the Zweig breadth thrust single. It's a really bullish thing in 23. We had a sharp rally. This correction that wiped out everybody pretty much on the long side, flipped back with another one. I think it was the first time since 1962 that you had a couple of these, and off to the races. Well, we're close to one now, and if you want to, you can look on stock charts. Arthur Hill, has a good updated discussion on what we need to see there and whether indeed we're going to see another one. You can see some other breadth thrust signals in the past. We're going to be talking more about sectors here in the next couple of weeks. Let's have a quick rundown. ETFs, only 21% are above, and you can see only LIT and XPI gave new weekly buy signals on the ETF side. If you're looking at growth, is still really weak at 10, but the value has dropped down to 36, and still the daily are all on the short ETF, and the long are still all red except for TNA. So that's we would expect, given the AD line indicators, to see a change there in the next week or two. Of course, big bank earnings start next week, and so we'll be watching that closely. Here's in the sector report, new 3 days with a new positive on SBAC. If you go down here to our charts, which are usually, market gauge here is 45%. So that's still, like to see it above 50. Energy still looks strong. Really does not suggest the top there. Materials, that's an encouraging move there, in terms of FCX, NEM. Those are material stocks, obviously. And APD is one I'm looking at. Has a very nice chart. Industrials, Jerry's new rating thing, this looks like it's trying to bottom out. Has not turned really positive yet, but I'll be watching. So Deere has, as a 4-hour, we'll be looking for new daily DTS signals in this group next week. Also for consumer discretionary, only CMGs looks at all interesting, and 8.3 above the with positive 3-day. That's not great, and a solid downtrend. Consumer staples also looks like to be a bit high risk, except for Costco and Walmart. Healthcare has been somewhat disappointing, but I think I would expect those recent lows to hold. We may need to give a little room, but I do expect that to be higher as we get fully into the second quarter. Financials, we're in that. It's in a solid, a gradual uptrend here, so it needs a stronger action to, kick that up. Technology so far has not been impressive. We just kind of turned up here. NVIDIA and ACN, our new DTS signals, but lots of red here, so we'll be keeping you up to date. We see some turns there. Communication is one that Jerry thinks is rolling over, and it's sort of a mixed bag here. It's been a great sector since 23, so we're not currently in that, but watching the action. Utilities seem to be some money moving out of those, and real estate seems to be a little more positive. A couple markets I kind of mentioned earlier. Rates still look higher. We had a little pullback here, so the MACD pattern here looks strong. So if we're right about this, the start of a new move higher in yields, we would look for yields to move back higher in the next couple of weeks. And also, I don't think we'll look too closely at the daily AD lines this time around. Of course, which is, you can see the bullish from the weekly. If we drop this down to the daily, you can see that it's moved back above its moving average, just hit the 20-day. Okay, that's at 658. So you could still get a day of slightly negative breadth early in the week, but then I would look for a strong, like a 3-to-1 or 4-to-1 day by the middle of next week to kick this into gear and complete this bottom formation. So stay tuned. I'll be updating you on Twitter. And as always, if you have any questions, Tom at Viper Report. And hope you have a great Easter and a great long weekend, and look for some sanity to return to the markets, hopefully in April. Thank you.